Thanks, Mike. So I'll be talking about Henderson Far East. We've got quite a few slides here, and as usual, there's a lot to talk about in Asia. So I'll get through them quite quickly, and hopefully we can talk about the more interesting points in the Q&A. So just to kick off, we have an introduction to what we do. So we're an investment company that invests in the Asia Pacific region. And we want to take advantage of the inherent growth in our region, but also a great story in terms of income growth. So we're seeing very strong dividend growth over the years in our region. And it's coming from a wide variety of sources. So all the way from North Asia to India, Indonesia, Australia as well. So a great amount of dividend growth coming through across our region. And we think that's quite unique in terms of offering income growth and capital growth. And we're just giving some examples of the kind of geographic exposures we have. So 5 of our biggest markets are China, Australia, Korea, Taiwan, and India. And they all do different things. So Australia and Taiwan are better known for their income. Taiwan, obviously, very well known for technology companies as well. And then in South Korea, we've seen some great corporate reform coming through. That's increased dividends there. India, actually, even though it's not a very high yielding market, has some great growth stories and actually globally is one of the highest dividend growth markets in the world. So even though it's starting from a low base, the actual level of dividend growth is very strong. And then China, a lot to talk about on China, but again, there's some very good growth coming through a recent corporate reform program that's pushing up dividends as well. And some very good bright spots which we are taking advantage of. Clearly some macro issues there, but there's some interesting areas that we like as well. And just to say that the track record is that we've got 16 consecutive years of dividend increases. And one of the objectives of the company is to increase the dividend per share every year. And the current yield is just over 10%. And I thought it was worth just a very quick word on the investment philosophy, because I think the way that we look at companies in our region is quite unique to the way that we manage the portfolio. And that is that we focus really on cash flow. So we are identifying companies that have mispriced that cash flow. So we focus more on cash flow and less on accounting-based measures, less on EPS, for example, PE ratios, but more on free cash flow yield, cash flow return on investment, those kind of measures. And that clearly is very much aligned to the way that we identify interesting names in our region. And of course, we're looking at total return as well. So we don't just own companies because they've high dividends. They have to have dividends and growth as well. And we've been ever more focused on that over the last 6 months or so, where we've made a few changes to reflect that in a better way. And then I'm based in Singapore. We have a team of analysts there. We meet companies. We travel around the region. That's very important to identify ideas as well in our region. And finally, it's a very similar point, but there's a focus on absolute valuation. So we're not just looking at relative valuation, saying a company is cheap because the rest of the sector is on certain valuation, certain PE rating, and this is therefore cheap for that reason. We're actually valuing that company using our models, and we have a range of outcomes. We can say that this company is worth X dollars, and that's the way we look at it, rather than saying it's cheap because it's 20% cheaper on a PE basis than the rest of the sector. So that's very important to actually identify what the company is worth, and that helps us to add to companies when they've fallen for no good reason, and also maintain that sell discipline when they go up. We have a team, as I mentioned. A lot of the people you see here are based in Singapore. So we have sector specialist analysts who are based in Singapore. And also I have 2 analysts who work with me to support me in this process as well. And then we have a number of other teams, for example, China team, who are very useful for us in terms of the knowledge that they have, the companies they meet, and the kind of models and analysis that they do as well. And of course, the wider technology team, a whole lot of other investment teams across our Janus Henderson investment platform. Again, just, I mentioned previously that we've been increasing the dividend consecutively for 16 years. You can see here that there's been a good pace of growth here over the years. The annual dividend per share has increased at a high level than, for example, FTSE 100. And we still think that the level of growth that we could see in our region is still very, very strong, starting from still at quite a low base. So the potential is very significant. I'll talk about that in a second. And just in terms of recent results, so we reported our 6-month results to the end of February 2004. So we had a good recovery in terms of our net asset value total return. It was up just over 8%. And that was well ahead of our, for example, the FTSE World Asia Pacific ex Japan index, and also ahead of our peers as well. And now we've moved to a premium over NAV, having had a period of discount. And the yield, as I mentioned, is just over 10%. The performance was a beneficiary of a number of things. So we'd repositioned the portfolio towards more growth and income areas and less cyclical areas as well. And that meant that we had this, I mentioned this corporate reform going on in Korea. That was quite a new development that boosted the share prices and the dividends of companies we owned in that market. We also benefited greatly from our Indian holdings. So that was actually our biggest contributor. Some of the infrastructure names there did very well. We had after that point then reduced India, which actually, looking at the volatility in that market today, seems to have been a good move. But we are interested in potentially adding more to that market. We do like the fundamentals there. And in Taiwan as well, technology did very well. So we had added more to technology in that area. And artificial intelligence just boosted the share price. But aside from that, there's still a lot of good things going on in those technology companies. So we had bought them because of electric vehicles, because of recovery in some smartphones in China, high-powered computing, cloud services. So a whole host of other things as well. It's not just AI, but that, of course, has been the big story in recent months. And then the income was down 3%, and that was a lot to do with the change in ex-dividend dates for Korean companies, and that meant the investment income fell. But then we did double our option premium income as well, so that supported the total number there. A quick macro update. I think this chart is very important. We've been actually showing this chart for over a decade now, and the reason for that is that the fundamentals are very supportive of increasing dividends. So cash on balance sheets is very high. CapEx to sales has been falling, and it's free cash flow positive. And many companies we own actually don't have any debt, or they are have some debt, but the cash balance is higher, so they're in a net cash position. Sorry, and therefore the underlying strength of corporates in our region is very supportive of higher dividends in the future. And this was actually, I mentioned earlier about, for example, in India. So Indonesia and India are seeing some of the highest dividend growth globally. Now, the dividends and for many of those companies in terms of yield are actually quite low. They're actually two reasonably expensive markets. But Asian companies, see Korea and China, that have been increasing dividends at a faster pace than many other regions globally. So that's a very positive sign. The good thing is that the actual level of dividends is still quite low. So the payout ratio, the amount that companies pay as a percentage of their earnings, is still very low. So that has great potential to increase. And that's the opportunity, is that as those companies increase dividends and sometimes against expectations, that can lead to a re-rating of that stock. And that's a key theme that we try and capitalize on within this investment company. And then we've got a list of companies here that have recently announced surprises. So I talked about some of this reform going on in China and Korea. So we have Nari Technology, a Chinese company, Kia, Korean company, and they've both increased quite significantly their dividends. And we've seen that across two Indian companies there, a Taiwanese company, another Indonesian company, China. So a whole host of sectors and country that give us great sector and geographical diversification. So, for example, we've seen dividends being cut in the mining sector in Australia, and that's a very significant part of many income funds in our region. But there's more diversification, so we can own other areas that have growing dividends. So if something doesn't work, there's always the opportunity to move into other areas where we see better growth and income. And that's the great thing about the kind of the region we invest in. There's a whole bunch of more mature markets that have very high dividends, Australia, Singapore, Hong Kong. But there's a whole host of countries that are growing dividends at a faster pace, albeit currently at a low level. And that would be, for example, India, Indonesia. So that's a very good mix for us overall. And again, on the macro, it's worth pointing out that inflation was never as big an issue as we saw in the Western market. So CPI inflation, actually, CPI level has been quite low. So we would expect in Asia to be quite volatile, because in Asia the food is a very big part of the CPI basket and can be close to 40-50% in some markets. But that's been reined in quite well. So we've not seen that same level of inflation shock to our markets, and that's led to central banks being in a much better position. And now I think most central banks will be ready to cut rates, but have been probably holding on to see what the Fed does, and just out of conservatism, just holding on to see how things pan out. But potential for more rate cuts, or some rate cuts in our region, is very real, and we think that would become very supportive for the consumer and for our markets generally as well. So that's a positive about our region. The other point we were making about China is that we have recently added a bit more to China. We're very cautious on the macro situation there, and that's not changed. But we are seeing that state-owned enterprises, corporates where there is large government ownership, have been forced, I should say, have been guided or maybe forced into boosting dividends and share buybacks. That's been really positive for those kind of companies, as it was in Korea. And this is a very Japanese style kind of corporate reform that we think will be quite long lasting. I mean, certainly in Korea, I think in China it's happening. We'll have to monitor that very closely. But I think Korea, it will be there for a number of years. So given that these kind of companies were very cheap in the first place and already have high dividends, this is an interesting area for us to add within the Chinese market. And we think that this is a theme that's not very well understood, but it's happening. It's happening across a number of sectors. And I was in Beijing just last month meeting these kind of companies, and we think it's a very real prospect that this could continue for some time. We also have added a bit more to Chinese technology in terms of more China internet companies, because we've seen that some of this tail risk around property bond defaults, local government potentially collapsing, currency devaluation, those risks have subsided to a degree. And that leaves a whole bunch of companies that are growing very fast, have great free cash flow generation, and are now looking very cheap. And they're actually starting to pay dividends and share buybacks in some cases. So I think that's an interesting theme as well. So we haven't, we have added to China, but we're still in a broadly neutral position. So we're not overweight versus the indices that we track. But we think there's a few select opportunities that could be interesting. But I'll say longer term, we're still very interested in markets such as India, Indonesia, Taiwan for its technology, infrastructure. Those kind of names are still, we think, more stable opportunities for the future. But we do like to see, where there's value names and income names are performing, we do like to be in those markets and take advantage of that. And then India, well, when I did these slides, I was not expecting the kind of volatility we've had over the last couple of days. It's been incredible. So on Monday, there were polls indicating that Modi was going to achieve maybe 350, 400 seats out of 543 total seats, giving him a clear majority, which had been not expected. The market had a very sharp move, and then the next day when the results came in, he was nowhere near that number. And he will have to form a coalition to stay in power. So there's a lot of uncertainty around that, and that's led to a huge amount of volatility in this market. Now, there's a lot we could talk about here, but I think the bottom line is, well, does this impact the India story? Well, I don't think it does, because two of the key drivers in India are physical infrastructure, which is going exceptionally well. There's been a record amount of budget from the government dedicated to capex here. That's still going very, very strong. You just have to go to Mumbai to see the amount of projects that are near completion there. It's quite incredible. And the other thing is the infrastructure around digitization. So we've seen a huge number of initiatives from the government to increase that. And what's that done is that it actually helps tax collection. So tax collection with the GST has gone up very sharply. that's a great plus for the Indian market. And also, digital payments are just, speeding up transactions. They are moving people towards digital, and that's a very strong theme. It means that, for example, banks have a lot of credit bureau information on customers. People already have ID cards, so that's been there for a number of years now, 10 years almost. And that, in terms of subsidies, cutting out corruption, those kind of things, there's a whole load of things going on. That will not stop because of this election result. Now, what will be a bit more difficult is that putting through some more reform will probably be difficult if you have to deal with coalition partners. However, there is a certain limit to what central governments can do in India. So they've already made reforms in terms of the banking sector, in terms of tax collection, GST, all of those things. Now, the real reform in terms of land labor reform, if you really want to build up manufacturing and those kind of things, has to be done at the state level. That's been an issue for the last 10 years since Modi has been in power. So that's nothing new. There's still a bit of friction, let's say, between central government and state governments. That's, still the same old story. So I think we need to see some improvement in that. And I don't think this result really impacts that much. So we'll have to see how that develops over the next few days. But it has created a lot of volatility. Potentially, some names we're looking at there, they could potentially be more attractive in this environment. So, we'll see how this develops. Keep a very close eye on that. But we are seeing some great growth in infrastructure. We're seeing greater spend on infrastructure and less on subsidies. These are very compelling charts here on this slide here. And then, example of names that were really ignored by the market. So we looked at utilities. Both the names we own have doubled. The valuations are good. The yield on power was 6% when we bought that name. We think these are great stories because they are beneficiaries of, for example, very strong power demand, but also renewable energy commitment from the Indian government. And that's playing through very nicely on these names now. So we think these are great stories, areas that were ignored for a long, long time. And only in the last 12, 18 months have they really started to work. Well, actually 12 months, I would say. So this has been the kind of area that we've been looking for. Something with yield, with good valuations in growth markets. And that's been a real feature of the way that we've been trying to change some of the holdings of the last 6 months. And then in terms of positioning, so why have we positioned the way we have? So it's not really about we want to reduce China, we want to add to India. We've been looking at what are the growth areas in our Asia region, and we came up with these 5 areas. And we've made sure that the portfolio is exposed to these great growth themes alongside dividends as well. And that, it's not an easy thing to do, but we spend a lot of time doing this, and we feel that the portfolio today reflects all of these themes. And we've added a new one on the end there. So if you saw at our AGM, we had the same chart, same slide, but the last column has changed because we now think that corporate reform in Korea and China is actually a genuinely compelling investment theme, and it has done well for us so far. So we think that's an interesting area as well. So we think that that kind of infrastructure build out, financial inclusion, technology, those kind of things are a real strength of our region. There's not many regions that can provide this kind of technology infrastructure for the global tech names. Financial inclusion, hundreds of millions of bank accounts opened in markets such as India and Indonesia. Some very strong consumer companies that are moving into international markets. And the level of infrastructure build out, we talked about India, but Indonesia, also other markets as well. China, of course, has done that for many years. There's a huge opportunity there as well, we think, especially in renewable energy, for example, grids and that kind of thing. And then I will just finish off with this slide here, and say that in summary, we have a strong track record of income growth. We are very much focused on dividends. Income is a priority for what we do, but we are trying to combine that with growth in our markets as well, and recapture some better performance by doing that. And we think that the kind of growth markets that we have in our region, for example, the likes of India, Indonesia, the technology names, these are very unique features of our market. and there's something we want to capitalize on. So it's a combination of income and capital growth that we are trying to capture, and that's why the portfolio has been repositioned the way it has done, is to do exactly that. The approach is very value driven. It's very focused on absolute valuation. There's a very disciplined process for stocks to get into the portfolio. We focus on cash. We have our own models. We speak to corporates. We analyze these within our team. We speak to other teams as well. So it's all those things that you would expect us to be doing, but it's quite a unique process because we focus more on cash flow, which is very aligned, theoretically very sound, looking at what kind of cash outflow do companies produce from the gross investment that they make. But it's very much aligned to our strategy and the way that we look at things. And, I've talked about these investment themes, but, these investment themes are really unique to our region. And so we must take advantage of the growth that's coming through and the dividend upside from those names as well. So that's a very quick run through, and hopefully you'll have many questions on this, but I'll be happy to answer that. So with that, I would leave it there.
Okay, thank you, Zat, for that run through. There have been some questions coming in whilst you were presenting, so we'll start with those. But just a reminder to the rest of the audience, do type away, and we'll try and get through all the questions. First one up from Keith Stevenson: is there going to be more emphasis on capital growth as opposed to income growth? From a total return point of view, the performance of the trust has been underwhelming since around 2020-21.
Yeah, so up until 2019, the performance numbers were very comparable to our peers, and in fact in good shape. And in 2020, the very sharp movement in growth names, especially technology, really hurt our performance. And then China after that as well has been quite negative for our performance. Now, we recognize that capital performance has to be improved, but we are also prioritizing income. Income is very important. What we do, dividend yield is very important. That's the objective of the trust, is to increase the dividend per share. So we think we can do both. And if you look at it's only 6 months, granted, but if you look at the last 6 months, we have increased the NAV. The capital performance has been better. We've seen the share price move, and we've been generating income as well in line with our expectations, and recently above our expectations. So we think that that's the unique thing about Asia, is that there is an opportunity to capture income and capital growth. And I think that if we can focus, we've always been focused on income, but I think we can focus a bit more on some of those great capital opportunities, and I've outlined many of those. Then I think we will be in a good spot, and that's really what we've done. Is that repositioning is very much to, in answer to your question, it's very much about that, is to make sure that those great themes, great growth themes that we have in our region are reflected in the holdings that we have, and we reduce those cyclical names, reduce those names with a dividend risk, and take away some of that exposure in China, for example, where there's a lot of macro risk. Some of those more industrial type companies, whether it's building materials, all that kind of thing. I mean, those are not really suitable investments for us at this point. What we want is growth and income, and we want to take away cyclicality, take away dividend risk, and those are the things we've been doing recently.
Right, thank you. David Hallis wants to know, what are the yield percents on the top 10 holdings, because he's puzzled how the trust manages to pay a dividend of more than 10% at the moment.
Yeah, so I mean, the yield obviously is a function of where the share price is, and the share price has come off quite a bit in recent times. We've had a move up recently, and that's kind of decompressed the yield from about 11% to 10%. And we think that if markets continue performing, then obviously the percentage yield will fall, and it will probably look less. Double-digit yield kind of optically looks a little bit unusual. But it is a function, obviously, of where the share price is. I would say that if you look at some of our top holdings, many of them are 7, 8, 9% yield. Some of them have been. We had a company recently that paid a 20% yield because they have a huge amount of cash on the balance sheet, huge amount of free cash flow generation, and they've decided that they're going to start paying this out very regularly. So there are great opportunities for income across our region. We also write options as well, and you'll see that in the last 6 months that we reported at the interim stage, we had doubled our income from options. So doing that is giving us more flexibility to be able to buy some more kind of growth type names. And so if you add all of those things up, and we talked about this in a little bit more detail at our AGM in January, is that all of those things are helping us to generate that level of yield. So that's a very sustainable thing in our view. We're seeing a lot of names that are generating those high levels of dividend yields. And of course, during the year, if we have names that are high yield but haven't performed well, but we still have the same conviction, we do add to those names. And so we like to add to high yield names where we think the story is very attractive. I mean, it's done selectively and only in those names that we like, but that can help us as well. And of course, over the course of a year, there will be new income names that we generate from meeting companies from our own analysis. And so there'll be new income names coming into the portfolio during the course of a year. And that can help to increase the total income as well. So it's a combination of those things. But options is something, the option premium is something quite unique to what we do, and that's increased quite substantially, and that's helped the income.
Could you just elaborate on that? The options. What's your option policy, and just talk, if you could talk through it in a bit more detail.
Yeah, so what we do is we write mainly call options. That generates quite a high level premium income. So over approximately over the expiry is normally 3 months. We can generate maybe sometimes 4, 5, 6, sometimes higher percent dividend yield. Essentially, it's the equivalent of, but we can generate that level of option premium in the order of 4 or 5% for 3 months from writing call options on existing positions. So what that means is that when that option expires, if the price of the stock is above the strike price, then we would give up that position. But what we do is we write very small amounts, and we do it over names that have already performed very well. So that gives us some flexibility, and we're fine to reduce those positions anyway. So it doesn't really interfere with the portfolio construction or our views, because we're when options go against us, we give up a small position. But we would be happy to do that anyway, because these stocks have already performed well. So we only do it on those names that are close to our valuation targets. And so it can be quite lucrative, because if you did that over 3 months and then you continue to do it on the same name for the rest of the year, that can generate a huge amount of effectively yield over that period. So that's it's not a most of our income obviously generate from dividends from underlying holdings, but doing that alongside our portfolio existing names just helps us to generate additional income and gives us a bit more flexibility to be able to buy some growth names that don't have very high yield but are growing their yield. And so it's something we've done for well over a decade, and we have a lot of experience in doing, and it's done very selectively. So it can be quite a complex area, but I would say that it's something that we do very selectively. We do it over positions when we write core positions that we already own, and it's done in very small amounts amongst a broad number of names that have already performed well.
Okay, and what kind of limits do you put around it? Have you got a bit of is there a limit as to how many call options you can have out there at any given time?
Yes, there is a limit. So the board sets the board of Henderson Far East will set a limit, and we work within that. And that limit has been relatively low. So our intention is not that we can double it again and so on. We've increased it now because there's volatility in the market. There's some great opportunities, and it gives us a bit more flexibility as we are trying to improve our capital performance, moving towards a combination of capital and income growth. But there is a limit that the board set, and we work within that limit.
So if you looked at the last 2 or 3 years, what kind of level of revenue have you generated from the option policies you've been pursuing as a percentage of your total revenues?
Yeah, so it's always been if you look at the last 2 3 years, it's been less than 10%. It's usually between the range of 6 to 8%.
Okay.
I mean, if you look at the last 6 months, you can probably expect that that will be a bit higher this year. But again, we work within our limits, and it's not going to be suddenly 30 40% of our income or anything like that. So
Yeah. Yeah.
we expect a bit higher, but still broadly around that range, a little bit.
Okay.
Bit
No, it's just interesting because I've not come across that before in any of the other investment trusts I happen to be involved with, and it just makes it a little bit more, or a little bit less transparent, if you like, for the investor, I suppose, is knowing how that's affecting the portfolio at any given time and so on. But interesting that you're doing that and getting some success from it. Just moving on, we've got another one from Taha Dohadwala. I hope I said that right, Taha. And it's about, what about the other Asian markets with huge population demographics other than Indonesia? You don't seem you don't see them being mentioned. So I wondered if you could comment on that.
Yeah, I mean, two of the biggest markets in South Asia in terms of population are India and Indonesia, and we have a very good positioning there. I mean, combined, it's actually quite a significant part of the portfolio. We don't have anything in Philippines, Malaysia, or Thailand at this point. Part of the reason is liquidity. So it's actually a market such as Philippines is quite interesting. But we see actually better opportunities in Indonesia and India at this point. And liquidity is very low on those names. And that's also an issue with Vietnam. So Vietnam is a very interesting market. And we have some exposure within the company to Vietnam as well. So I think we do have some very good exposure to those kind of markets. And I would say that Vietnam, Indonesia, and India are the three most compelling markets in that region from a growth point of view, and we've found some good opportunities there. So I believe we are invested, but of course there'll be other markets that are just a little bit more difficult to access, and they haven't really developed very well in terms of capital markets. Liquidity is quite low, and so we monitor that, and we would like to get access to interesting names in other markets. But I think that those three markets alone are really very attractive, and there is yield as well to be had in those markets as well. So I think the exposure is quite well balanced between those kind of South Asian growth markets and also some of the more higher yield, you could say less growth in North Asia. And then obviously the more developed markets such as Australia and Singapore that have very high yields anyway, but have much less growth. So it's finding a balance, because we want to have income and capital growth, so we have to manage where we are with a view to those markets.
Okay, thank you. Tom Jury wants to know, what is the current and projected split of income between investment income and option premiums? You've sort of touched on that but already, obviously, but you might want to go into a bit more detail. And also, secondary question, what is the current position on revenue reserves?
Okay, so in terms of the options, as we just spoke about, historically, or certainly in recent years, it's been between 6 to 8% of our total income. So it's not been very significant, but it's just given a bit more flexibility. And we have in the first half doubled our option premium. And so I think it's a fair expectation that this year that number will be a higher percentage. But it's still going to be the minority of our income. It's not going to go up to, as I mentioned, so 20 30%. It would still be quite a relatively small number. And as I said, we work within a limit that the board sets on these things, and that's something that's always been in place. So there will be a limitation to how much we do from that. So I think we shouldn't expect that to be very significant part of our income overall. In terms of revenue reserve, as you will know, last year we did utilize our revenue reserve. We felt that China in particular, which is generating a lot of income, was something that struck us as being quite high risk at that point. And so we reduced our China exposure, and that meant we reduced a lot of names that were going to pay a lot of big dividends. But we felt it was better to use our revenue reserve rather than take the capital hit from just owning those names just because they have the income. And so that was partly a reason as to why we utilized the revenue reserve. I mean, our expectation. So another thing I should mention is that the strength of sterling also went against us as well. So that made effectively it made that income less when it was converted towards sterling. And so that's something where obviously looking at. We have to. It's a bit difficult to know how that will pan out by the end of our financial year. But those kind of things have an impact on our income generation, and therefore the board decided it was the right thing to use the revenue reserve, because I mean that's what they're there for. I mean we've built up our revenue reserve since about 2007 from zero. So we've been putting away a little bit of income every year to support the build up of that. So it's something that we've done in quite a short space of time, something that we can do in the future as well, is to rebuild that. But the point is that we think it's there to be used, and if it's something that will help our capital performance, and not have to buy income stocks just for the sake of buying income stocks, then I think it's a fair thing for the board to consider to be utilized. But our expectation at that point was that we expected income growth to be much stronger in future, and that would support more underlying generation of income and less use of the revenue reserve over time. I have to say, with some of this reform we've seen, for example, in Korea and China recently, and I showed you that slide with the dividend surprises, there's some very big numbers on there. Some companies have reported dividends 30–40% higher than we had expected. So I think we are traveling in the right direction with respect to income growth. So the expectation was that the revenue reserve utilization would be a temporary measure, certainly at that level, and that we would see income growth coming back to a stronger number, and that would support the underlying number that we see for dividend income for the portfolio. So that hasn't changed since we talked about that back, for example, at the AGM in January. That is still our expectation, that growth will be stronger. Revenue reserve is something we will have to utilize less.
Okay, thank you. Brian Tilson mentions that over the last 5 years, the current share price is down approximately 40%. Were some of the underlying dividend traps, he's saying, I'm not quite sure, some of the underlying problems, maybe dividend traps, I guess he's asking, may have got that wrong. And how can investors be reassured that this will not reoccur? Perhaps you could just talk us through what you think has been the main contributor to that drop in current share price. I know you've hinted at it already, I think, in previous comments, but maybe you wish to add to that.
Yeah, so I mean, I guess rather than dividend traps, value traps may be a better description.
Value traps, maybe that's it. Yeah.
So there's been, there've been some markets, for example, China, that pay very high dividends. But many of those names are potentially value traps because they just don't perform. And so they give you dividends, and they tend to be a bit more cyclical in nature. And dividends sometimes is not sustainable, or if it is sustainable, the performance is not very good. So what we've done, for example, is moved away from a lot of areas. For example, we have reduced China overall versus where our positioning was maybe 3 years ago. We've reduced, for example, telecommunication companies pretty much down to close to zero holdings there. Just a couple of holdings now, very small part of the portfolio. REITs, again, we've reduced as well, real estate investment trust. Those kind of things always appear defensive, and they appear to have high yield, but they don't have any growth. And we've been a lot more, also a lot more brutal in terms of the way that we look at these names. We want them to have income, high income, and growth. And if they don't do that, then they don't exist in the portfolio. There's no place for those kind of holdings in our portfolio. So we've been a lot more strict with the definition on those kind of things. And we've moved away from more cyclical companies where dividends could have disappointed, especially in China. And so there has been that repositioning. So that slide I showed earlier with what we think are the great investment themes in Asia, the great growth areas, and they are producing income. That's where we've repositioned to. So there are a number of changes that were made to the portfolio holdings around October, November. And we think that the performance for the 6 months was a reflection of some of those some of those great combination of income and growth stories within our region. And frankly, Asia region is one of the fastest growing regions globally. So we should be taking advantage of that growth. We should own names that have great structural growth. But there's also a lot of dividends in our region. So one of the questions earlier was, well, what kind of percentage dividend yields do you have from our holdings? Well, we have a whole number of holdings that are paying 6, 7, 8, even 9% yield. And then we have the option strategy alongside that to boost the income as well. So, there's a lot of opportunity for capital and income, and that's what's so unique about our region. So we think that we've moved away from some of those value traps. We've moved away from the most cyclical names that are disappointed on dividends and performance as well. And we think that we have a very compelling growth, underlying growth in the portfolio now. And that's we think there's been some early signs of that recently in terms of performance, and we hope that will continue, because it's a really compelling area, very interesting. And when I look at other regions and look at some of the growth prospects in other regions, I mean, this is really hands down some of the most interesting names globally. And so this is something we're very excited about. So this is how we've addressed that performance issue, is by moving into those kind of areas, but without compromising the yield. The income generating capacity of the portfolio is the same after these changes. So that's a very key message.
Oh, right. Okay. That's useful to know. Alex Mayo, perhaps along the same lines, what changes have you made to your portfolio to reverse the decline in your share price in the last 6 months? But I think you've sort of covered that one off already in what you've just been telling us, really. So with Alex, I'm not seeking Alex's permission, but I'm moving on from that one. What is the portfolio turnover, past, present, and future? Tom's asking. I'm guessing with all the changes you've been making, it's probably gone up a bit recently, but maybe you could talk us through that.
Yeah, that's a fair point. So the changes we made around the October-November period will contribute to higher portfolio turnover. So I think that it's for those reasons our portfolio turnover has been declining for 3 years now, and last year it was around 85%, which is still too high. So we're working on reducing that level of turnover. Now that we've introduced all of these structural growth names with income, we feel that these names can be held for with a view to at least the next 2 or 3 years. I mean, actually beyond that, but certainly for that level of period. So that should help to reduce the turnover over time. But because of those changes we've made, it's difficult to say whether we would be able to reduce portfolio turnover this year. But I certainly recognize that level is too high, and we do need to do something about that. So we are working very hard behind the scenes to make sure that we are, restructured into more kind of sustainable growth areas where we see more sustainable income growth. And some of these things, such as the Korean names, have really surprised us positively on dividends. And these are names that we want to hold for a number of years into the future. So that should be hopefully positive news in terms of turnover if we look ahead for the next few years.
Okay, thank you. Robin Healy would like to know, have you got any difficulties in extracting cash from China or India, but maybe from some of the other countries that are in the portfolio as well, you might wish to comment on?
Not at all. So no issues on that front. We receive dividends that come through. There's never an issue with that. So there's a lot of things that I talked about some of these markets, and of course some of those things are true. But market access and these kind of issues around cash, whatever, that's never been an issue. I mean, I think that corporate governance has improved hugely around these markets, and still a long way to go. But there has been a lot of improvement, and especially in capital markets in many of these markets. I mean, I actually was in India just a few weeks ago. We met the regulator, the Securities Exchange Board in India, and they are very progressive. They are working very hard behind the scenes in terms of technology, in terms of educating investors, all of these kind of things. So that's going on in many of our markets, and I think that's something that's not well understood. So I would say that there's certainly nothing to kind of worry about in that respect. And I would say actually the positive thing is that these kind of improvements to our capital markets around the region are very real. And we have met regulators. We've sat face to face with these people and we've talked about it. And we're convinced that they're on the right path here. So I think that will only get better into the future.
Okay, so you're reasonably confident on that front. That's good to know. The AIC, according to David Hallows, quotes revenue reserves as 21.57 million with divvy cover at 0.55. Is that correct? I assume that's based on your last set of accounts, as whenever that was.
Yes, so so that's at the financial year end, it was just over 21 million pounds. So that's correct.
Yeah.
Um,
okay.
Yeah, so the dividend cover number I don't have to hand exactly, but I think it's we can certainly provide those.
Fairly
But,
simple mathematics for that, I assume. Yeah.
but yeah, that sounds about right. Yeah.
Okay. All right. Thank you. Well, we're all out of questions, so well, pretty good timing. We managed to get in within the hour. So thank you very much, Sat, for that. It was a good run through and useful to hear a bit more about some of these markets, which obviously are not that familiar with many of us, to many of us. So I found that quite fascinating, actually. So thank you for your time today. And
Thank you, Mike.